Imagine waking up one morning and realizing your credit card bill feels different. Not smaller, different. The interest isn't exploding the way it used to. The minimum payment suddenly makes sense, and the banks are very quiet about it. That's the uncomfortable truth behind Trump's proposed 10% credit card interest cap. On the surface, it sounds simple, even boring. Cap interest at 10%, protect consumers, end predatory lending. But nothing in finance is ever just one move. And if this actually happens, it won't just change your credit card. It will quietly rewire the entire consumer debt system. Right now matters, because credit card interest is out of control. The average rate in the US is hovering around 20 to 25%. Some cards are north of 30%. That's not a typo. That's legal. Americans are carrying over $1 trillion in credit card debt, and a big chunk of monthly payments isn't paying for stuff anymore. It's paying for time. Interest is the price of not being able to pay today. Trump's proposal attacks that price directly, a hard ceiling, 10%, no loopholes, no teaser rates that explode later. Sounds like relief. So let's slow down and look at how this system actually works. Banks don't make money when you swipe the card. They make money when you don't pay it off. Every unpaid balance becomes a small subscription to debt. Interest compounds, fees stack, time does the rest. High interest isn't an accident, it's the business model. Now imagine that model capped at 10%. Suddenly, carrying a balance is cheaper. Too cheap. Here's the uncomfortable math. If you owe $5,000 at 25%, interest alone is over $1,200 a year. At 10%, it drops to $500. That sounds like a win, and for consumers already drowning, it is. But for banks, that's billions in lost revenue. Not over decades, immediately. So what happens next is where things get interesting. Banks don't absorb losses quietly. They reroute them. If interest can't go up, something else will. Credit limits tighten, approval standards get stricter, annual fees suddenly make a comeback. Risky borrowers don't get cheaper credit, they get no credit. The irony is sharp. The people the cap is meant to help may be the first ones locked out. Meanwhile, rewards cards don't make sense anymore. Cashback, travel points, 0% offers. Those are funded by high interest on someone else's balance. Take away the fuel, and the perks vanish. So the hype says this kills predatory lending. The reality is messier. It shifts power. From lenders who price risk with interest to lenders who avoid risk altogether. Zoom out, and the implications get bigger. A 10% cap doesn't just touch credit cards. It pressures auto loans, personal loans, buy now, pay later. It tells the market that profit has a ceiling. That's not capitalism as usual. That's regulation with teeth. Supporters say it brings fairness back. Critics say it freezes credit during uncertainty. Both can be true, because the real question isn't whether 10% is good or bad. It's what happens when debt stops being expensive and starts being scarce. Does that protect households, or does it quietly separate people who already have money from people who need it most? If this cap becomes real, everything changes. Not loudly, not overnight, but slowly, structurally, and permanently. And the final outcome won't be decided by speeches or headlines. It'll be decided by who still gets approved when the interest is capped and the risk isn't.